need a mic, LaShawn.
Hey guys, I hope all of you guys are doing good today on this Tuesday. We have an exciting topic for you. Are you self employed? Are you a small business owner? Have you ever wondered what is it that you need to do to qualify for a mortgage? What challenges have you faced when you try to qualify for a mortgage? If those are questions that are in your head, this is the episode for you. My name is LaShawn Abraham. I am the sales manager at Gill Mortgage in Summerville, South Carolina. I am joined today by my husband, Gavin, and one of our very, 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 very good friends and business partners, Mr. Wilmot Berry. So, guys, go ahead and introduce yourself.
Sweet, sweet. Well, before Wilmot does his famous introduction, my name is Gavin Abraham, right here in Somerville. Guys, part of half the team Abraham. As you know, we're always excited to do Teach Me Tuesday, and today is no different. So I'll let Wilmot jump in and introduce himself, and we'll get this thing kicked off.
Appreciate it. But before I introduce myself, that's a great question. We're going to tackle that
We're going to
today.
talk about that.
Oh yeah. By Dime. So Wilmot Berry with the Berry Group, brokered by EXP Realty here in Orangeburg, South Carolina, and serving surrounding areas, helping my people reach their real estate goals. So super excited about this topic because I run into this a lot with my clients. Right? They call me. They say, Wilmot, hey, I'm a truck driver. I'm a barber. I'm a small business owner. And they're asking about how can I get approved for a loan? Are there any differences from them getting approved compared to someone that has a 9 to 5 that's trying to get approved? So I'm gonna let you guys kind of start it off because you guys are the professionals when it comes to that side when someone is trying to get approved for a loan. So if y'all can just start it off and tell us, so what do you deal with on that side when it comes to a small business owner?
So that's a really good question, and I'm so glad we're having this topic because honestly, right now I feel like there is, especially since COVID, I think there has been a huge influx of small business owners, self-employed people. And so first, I'm going to say there is a difference between being a small business owner and being
Mm-hmm.
self-employed, right?
Mm,
Because being self-employed just kind of means like you may went out there and got an LLC, you may haven't. You might just do some work on the side and just decide to report it or not. And then, but
Yeah.
a business owner is someone who truly maybe has some employees under them. They might file, their taxes a little differently, whether you're filing like an actual corporation or if you have a
Mm.
partner and you're filing like a partnership or something like that. So there is a difference between the two. So we're going to kind of touch a little bit on both. But I do want to dive into just to kind of get stuff started because we like for this to be interactive when we do these lives, which is the purpose
Right.
of us doing them. We want to be able to go back and forth and converse with the people who are tuning in. So, business credit, we get that a lot because one of the main things that people say to us is, oh, yeah, I want to buy a house, but I want to put it in my business name. I want to put it in my LLC name. How do
Mm-hmm.
I do that?
mm,
So, here's the answer to that question, right? When you purchase a home and you want to put it in a business name, technically it's considered a business loan. It's a business loan or that could be considered a commercial loan. It's not
mm,
a residential mortgage because a business
Mm-hmm.
is an entity. When you go to buy a house, like in a residential side, which is what we do here, we sell residential real estate, and you might do both commercial and residential. So there's a difference. So if you're wanting to open a business and you want to have that business established to purchase a home for you, then technically you really need to be searching for a business loan. And usually, in order to do so, you're going to need business credit because if
Mm-hmm.
you don't have business credit, then you're going to need to become what's called a personal guarantor for the business because if you haven't had your business established for at least typically 2 years, if you can't show where your business has truly generated revenue and you're able to demonstrate that usually via with tax returns and things of that sort, then trying to get a business loan is a little bit difficult. So what some people may do instead is you might decide to purchase the home on the regular residential route, and then once that is paid off, then you can move that deed over to a business or LLC.
yep. I see that. I see a lot of my investors do that a lot.
Mhm.
With all of their investment properties, they put their properties in an LLC. You know, it kind of it protects them. You know, especially if they have tenants in there, it protects them on the liability side. If something were to happen, it's not tied to their actual, you know, their personal. You see what I'm saying? So I do see a lot of my investors put their properties in an LLC. So
Yeah, and so the reason for that, honestly, and it's smart to do because just like
Mhm.
kind of like we talked about in previous sessions, and Dime, I will answer the second part of your question
Right.
as well, is that typically what happens is the debt to income ratio is still a factor. So
mm,
as a person starts building their portfolio and own more than one house, and if you start having all these houses underneath your personal name, or
mm,
whatever, and that can really impact your debt to income ratio. And
Right.
once it starts to impact the debt to income ratio, then it's going to really kind of drive how much of a loan you can get or how many more houses you can buy without having to have a lot of cash. And so most investors may, start moving some of those properties off of their personal credit into a business so that way they can kind of free up some space to do some more stuff.
yeah, and I also believe it's a tax benefit as well
Hmm.
when they put it in the LLC. So I think that's a topic all by itself
Yeah.
that we need to come on here and do for the people. So I think that would definitely be beneficial to people that are thinking about, hey, I want to become an investor. How do investors move? You
Yeah.
know,
That's true.
so that's a really good topic for the people when it comes to that. So let me ask you this, LaShawn and Gavin, what are some of the challenges that a small business owner that you see that they run into, you know, your common challenges for the small business owner when they're trying to get a home or trying to get
Well,
approved?
well, yeah. I mean, probably most common that we see. Um, a lot of small businesses don't have good record keeping, um, to where
Mm,
a lot of businesses are looking to write off as much as they can so that they can, pay the least in taxes or whatever it may be, which is smart from a business sense.
trying to get the
But
write-offs. Got to get the
yeah, they're
write-offs,
trying to get as
right?
much write-offs as they can. They want to lower, um, you know, they want to increase their expenses and lower their
The income.
profits so they can pay
Hmm.
less taxes on it.
Hmm.
But when it comes to preparing yourself to be able to purchase a mortgage, I mean, guys, what we're looking for is to see how profitable you are. What net income are you coming home with, because that's what we can qualify you on. If you're saying that your business is expense heavy, then that's going to become your main priority, your main focus over paying your mortgage. Is the risk factor
Mm,
that we would be looking at, or an underwriter would look at. So it's all about showing the most income that you can. So that's number one. A lot of small business owners, just because and again, it's not that they're doing anything wrong, but they're taking advantage of the system that was created for that purpose. I mean, small bit, they created all kind of tax credits and things of that sort so that you could benefit from contributing as a small business owner to the economy, but also at the same token, give you that added benefit of not having to be taxed crazy, because there are so many different write-offs and things available to small business owners. I think another
And I want
um,
to ask that before you go to the second one, if you don't
okay.
mind, is that what I've seen happen a lot of times too is when it comes to that record keeping that you mentioned, I feel like there's just a lack of preparation, right? Because I went to a meeting recently, and sometimes people just decide, hey, I want to buy a house, right?
Mhm.
And they just kind of jump in. They go ahead and jump in the deep end, but they don't like necessarily really think about their prior behaviors, right? Because typically when they go to try to qualify to purchase a home, we're not just looking at what you're doing presently. We're looking at what you have also done the past 2 years.
Right.
And so if there isn't proper planning prior to you making the decision to buy a house, then that can kind of derail things a lot. So one of the things I tell people is, especially like this time of year is perfect.
Yes,
We're about
indeed.
to enter into 2024 in a couple of months. You have not filed taxes yet for 23. You might have not even filed for 22. But and if you know you want to buy a house, then you should definitely you need to have a team, I feel like, in all facets of life, right?
Mm.
And so in this particular space, you should, before you file your taxes, you need to have a very good realtor. If you want to buy a house, you need to have a very good lender and a very good tax or CPA person. And those people need to all be talking together on your behalf. Because as a lender, we know, how much income you need to purchase this house. The realtor knows, what type of house you want and what that house is going to cost. And that tax person or CPA, then they need to know how much income they need to show. Because there are creative ways that a person can file your taxes where we can add back things. And so you can write certain things off, but there's also add back from the mortgage side. But that tax person needs to be talking to your lender as well before they report your taxes. Because once it's reported and you go back and try to amend it, then that's a whole nother problem. And that can open up a whole nother can of worms. And you don't want that, because then it will set you further back, or it's going to cost you a lot more money. And so I will say that can be a huge challenge as well.
Wow, that's really good, because we always look at tax season as small business owners like, oh man, I'm trying not to pay Uncle Sam, all I need to pay him, but then looking at it from a future standpoint, like, hey, I need to, if I'm trying to buy a house, I need to consider these things, talk with a professional about, hey, what do I need to show in my taxes so that, hey, I can get my home or get approved for my home within the next couple months. So I think that's so important, because I get it. I'm a small business owner. I try to figure out what the write-offs are, and I mean, thank God, I got my house. So, I can kind of
show what you want.
show what I need to show, but for the person that's actually really pursuing that next year in 2024, you want to be prepared, which leads me into my next question is, hey, what are some things that they can do other than like what you just gave to prepare themselves? What are some common things you notice there and a lot of people aren't prepared for when they're trying to apply for approval?
Yeah, I mean, for one, understanding, because so we have a lot of new business owners, right? That have just become business owners within the last year or two. Understanding that what's required of you is a 2-year history. We need to see an established income pattern for 2 years to where we can document and say that, hey, this is what we're going to qualify you off of, because we've seen that your business has for your last 2 tax returns, you've claimed this amount, you've profited this amount of money, or you netted this amount to move forward. So we have a true history, because to Dime's question that she asked, as far as like consistency, in a business, some businesses, especially small businesses, and especially if you've been affected, you could have been negatively affected with COVID over the past few years. So you could have had a business that's been established for 10 years, but guess what? As a hospitality, or let's say a restaurant business, where things shut down for quite a while back when COVID first hit, people weren't going to restaurants or eating out, as often, just because of the nature of what was going on. And that took a lot of hits. So people didn't net as much as they would have from their small, their restaurant or their small business. And now when they come to file their taxes, well, it shows that this was a dip. Well, we still have to take that in consideration, regardless of what you did in prior years, because, COVID isn't over. And the things that impacted you this year could possibly still be an impact for you going forward. So now we need to see in the next year or 2 years to see you change that. Let's see that those numbers have increased or going back up. So sometimes it requires for them to wait for 2022 or 2023 to roll around to where, now they show more income. They show that hit was just because of this, what happened in 2021 or whatever the case may have been. And now I'm reporting, more net income in the following years. Sean, you want to add to that?
So yeah, so that's good stuff. So if you're just tuning in, we're diving into, small business owner lending options, because we know that, a lot of people are self-employed, or a lot of people may be employed and self-employed, and they want to buy a house. They have a desire to buy a house, but every time they try to buy a house, it's either, they run into the situation where they make the money, they truly make the money, but they don't necessarily show the money. So we're talking about just how do you prepare for it. And we're also going to tell you about what type of loan options that are out there, because there are loan options out there that are for people who may be like, I don't want to change my taxes. Is there something else I can do? Just stay tuned. We got some other financing options for those people who may not want to necessarily go what I call the traditional route. But to add to what you said, Gavin, is I absolutely agree with you. That consistency is important, right? Because even if you had a W-2 job, it's important, because an underwriter, a lender in general, don't want to see your income fluctuating, going up and down. That's considered unstable. And so sometimes we ask for something called a profit and loss statement as well. And so if you guys are not familiar with that, it's pretty much, it's kind of like what Gavin mentioned, start on, is that record keeping. It's a record keeping of how much profit are you making? What are your expenses? And at the end of the day, at the end of that month, at the end of the year, at the end of the quarter, however you actually do your financial planning, is it a profit or is it a loss? Because if you consistently take a loss on your taxes year after year, and now you want to buy a house, you're going to have to show a lot more income to kind of offset these previous years that you didn't show as much money. And so you want to try to avoid that. So I tell people to make sure they have a good tax person in their pocket, a good bookkeeper, because some tax people may do taxes and bookkeeping. Some of them don't. But you want to make sure you have that team together, so that way you can help prepare for, home ownership. And so one of the things I want to say as well, as far as I call it the non-traditional route, because there is options out there, right? And so say, for example, if you're like, okay, is there something else I can do if I don't want to touch my taxes? I don't want to have to pay Uncle Sam back, more money. And so, there's something they're called non-QM loans, which stands for non-qualified mortgages. So we have options to do something called a bank statement loan. So if people are familiar with that, instead of using your tax returns, we actually use your bank statements to qualify. But this is how this works, right? Because not everybody can go this route. People call us all the time. It's like, oh yeah, tell me about that bank statement loan. Tell me about the bank statement loan. But you have to know that in the lending space, everything is about risk, right? And so whenever we're not using your actual tax returns, that's a risk, because you're not reporting this money. We don't have a way to truly verify and validate it. So we're going an alternative route. So when there's a bigger risk, it's going to cost you more money typically, or they want you to be a lot more qualified. So usually in order to do something called a bank statement loan, one, you have to have pretty good to decent credit. And when I say good to decent credit, I mean those scores need to be in the high 600s, like 680 or higher. You also going to be required to put down a higher down payment. You're going to typically need about 20% to put down. And so you have to make sure that you're prepared to put down more money. You can't do down payment assistance without filing your taxes and stuff like that. So you can't get these first-time homebuyer deals while you're in a program like this. So there are pros and cons to each of it, but just knowing that there are alternatives out there as well.
That's good. You went right into that, LaShawn. I was actually going to ask you about, pros and cons, the benefits of, what kind of options do they have? And you went into that bank statement loan. I was always curious about that, because I do have, my clients, they make great money, and they're small business owners. However, they might have, let me see. I see the question. I'm sorry.
Okay, go ahead. Mr. Mentor.
Oh yeah. Let's talk. Let's definitely talk. Oh yeah, we'll definitely talk about that. Dime. I'll hit you up. Okay. So, but yeah, that bank statement loan was a big one for some of my clients because they were like, man, I could definitely prove that I'm bringing in the money. I don't mind putting down a bigger down payment, but like you said, that credit score got to be higher though.
Yeah.
You
Right.
know,
And the down
um,
payment's higher too.
yeah, credit score, down payment, so it comes with a cost. You
Mhm.
know, pay the cost to be the boss. Get it?
Yeah,
Yeah,
yeah. I mean, because you got to remember, there's a lot of businesses out there are cash based as well. So,
yeah,
those are some of the hurdles that we run into with
yeah,
small business owners as well. Man, is that you know
yeah,
instead of getting bank deposits or because this is where that record keeping comes into play. When you're accepting cash, there's no traceability. For cash,
yeah,
you have to document that in some source, whether it's a ledger or QuickBooks, whatever financial tool that you use, and it has to balance out. I mean, you have to. If you don't have that accurate record keeping, you can't come to me and say, yeah, I mean, I make all this money, I get paid in cash, but I don't document it, I don't record it, I don't do it anywhere. So
yeah, yeah.
that's a hurdle as well that sometimes small business owners run into, just because, like I said, that this record keeping is key.
Yeah, yeah, I noticed that a lot, man. Unfortunately, and I get it. You
Mhm.
know, you don't show it all. You can have, you know, a good bit of cash, sitting to the side or what so. But guys, if you're thinking about buying a home,
Hmm.
if you're serious about buying a home,
Hmm.
it's important for us to start operating like we want to buy a home, okay? Because we're gonna have to go through the lenders, unless you have all cash. Let me take that back.
Mhm.
Unless you have all cash to buy the house you want, you don't have to worry about that.
Right.
But if you want to get a loan for a house, you're gonna have to start documenting your income, okay? And so that you can prove this is what you're making to the bank,
Mhm.
okay?
Yeah, that's so
Yeah.
true. So true.
It is it's hard. It's really hard. You can't really get around that. So you gave us some ways that we can prepare. You gave us some other options. Like, so I know a lot of times I'm always dealing with homeowners. I'm not always, but majority of the time I'm dealing with home buyers that are, hey, I work a job, right? So they can get you know, the FHA loan, and can they get approved for a FHA loan as well? A small business owner, can they get approved for FHA loan?
Yeah,
Okay.
absolutely.
All
So,
right.
so a small business owner actually, or a self-employed person, they
Mm-hmm.
can they can truly do any type of loan, but
Okay.
it goes back to the same thing about the record keeping, right?
Record keeping.
The benefits of going FHA versus trying to do like a bank statement loan is that FHA, you only got to put down 3.5%.
Right.
Mm-hmm.
Usually, if your income is not exceeding some of the limits, there may be down payment assistance options
Mm-hmm.
available as well. But that it goes back to the record keeping. I think someone said this to me. It had been years ago, and they used the term what when a person goes through the process of purchasing a home. What it really does is it kind of exposes and magnifies a lot of things that we know that we probably need to tighten up on, right?
Mhm.
Yeah. Yeah.
Because typically if you ain't really trying to finance nothing, you're typically not always looking at your taxes, trying to report and save and figure out numbers here. You're not as focused and in tune on those things. But when you go to buy a house, because we start asking for these documentation to support this or whatever, then what ends up happening is now you're scrambling, right? You're scrambling like, oh man, let me
So
call my tax person, or oh man, let me see if I can put this money in the bank. And typically at that point, it's too late.
right.
So one of
Mm-hmm.
the things that I would strongly encourage people to do, especially if you're a small business owner and you're self-employed and you want to buy a house, you haven't bought a home, you're desiring to buy a house, start planning now, because
Mm-hmm.
sometimes you might need that 1 year, 2 year record in order for it to happen. And sometimes you can't just decide to wake up today and do it and just be able to just fly through it. Not saying
Yeah.
that it's impossible, but like we mentioned before, typically if you're going to go the bank statement route, just to kind of dive in that just a little bit more, is people think just because I have $200,000 in the bank, oh, I should be able to do a bank statement loan. I got enough cash in the bank to cover majority of it. That's not what we mean by bank statement loan.
Mm.
What that means is that we'll typically collect anywhere from 12 months to a year 12 months to 2 years of bank statements, right? So we'll get 2 years of bank statements. So that's 24 bank statements. And so what they're looking for is every month consistently, how much money are you depositing in your bank account? So there's a consistency still there. So you still just can't have, well, 1 month you put in $10,000. Oh, the next couple months you didn't put in nothing. Another month you came and dumped $20,000. No, you can't do that. It has to be a consistent flow so that we can get a sense of, on average, how much money is your business really bringing in. And honestly speaking, as a business owner or as a self-employed person, you should know that. You should know how much money is your business really generating, right? And now, not even that, one of the things we didn't talk about, but I like to make sure I give this disclaimer because this is a little bit more of a riskier loan when you do a bank statement loan. The interest rates are higher too.
They are.
So typically right now rates are pushing 7 to 8%.
Or conventional FHA loan.
A traditional FHA or conventional loan. So if you go and get a bank statement loan, those rates are 10, 11, 12%. And so you have to be prepared for that. So it's kind of like, I tell people there's nothing out there truly for free. You're going to pay for it in one way or the other. So either you're going to pay for it in the route of show more money on your taxes, where you can get set up on a payment plan with the IRS to pay those taxes. Or if you want to avoid the tax route, then you're going to pay a higher down payment if you go the bank statement route, and a higher interest rate because those loans are curving a lot of the paperwork for you.
Yeah. Got to choose one. Got to choose one, guys. So
yes, 10 to 12%. Now this is bank statement loans, so not on like your traditional
not
FHA or conventional. But if you want to go bank statement, those rates are 10, 12%. Yes.
Wow. Yeah, that's a big jump from my typical interest rates.
Correct.
So, well, shoot. I mean, are there any more questions out there that might have popped up before
we end this one for today?
Mm-hmm.
We talked about business credit. I think, did we go back and address the, nope, I don't think we answered the rest of Dime's question. So she said, her question was, is when applying, okay, let me actually show it so that way everybody can see it. So it says, so when applying for, pretty much you're talking about like a business credit or whatever, do you still have to get your personal credit pulled as well? Yeah, so if your business doesn't have business credit, so what that means is that the easy way that I can explain that is like, even though we work for a mortgage company, we're pretty much self-employed. So we get stuff in the mail all the time from like Uline or Vistaprint or whatever that has our business name on it and stuff like that. And we can open up credit cards, we can open up a line of credit, or we can open up some kind of marketing account with these little services that provide things for businesses. And as we continue, just like building regular credit, like your personal credit, as you continue to pay things on time, it'll establish business credit for you because you should have an EIN number that's attached to you versus your social security number. So as that EIN number gets more established, you can open things up just in a business name without them pulling your credit. They will actually pull the EIN number. But if you just started your business and you just started doing these things, then what ends up happening is you can't truly just do that. Instead, you have to become the personal guarantor for the business. So they'll still put it in your business name, but they're going to pull your business. They're going to pull your personal credit in place of your business because your business don't have the credit yet. So you just have to be careful with that because sometimes it'll still show on your personal credit. And so when you're going to try to apply for a loan, and a mortgage loan specifically, in order for us to not count this business debt against you, this is where record keeping coming real good too, is that you have to prove that your business is paying that debt. And so how you do that is a lot of people, like to mix their business funds and their personal funds together. You should have a separate business bank account and you should be putting your money in a business bank account that your business is making. If you pay yourself a salary or a paycheck or something like that, then that's fine. Put that in your personal funds. But business income should go in a business account. And when you go and pay your business, like a car, if your car going to be your business car, pay it out of your business account. So that way you can have a record that your business is paying this debt and not you paying those debts.
All right.
Yeah.
That was spot on.
There
Very
you go.
important.
Yeah, and for you guys out there, I mean, I know with businesses, it depends on, you got different types. You got S
Yeah.
corp, C
Yeah.
corp. You got, you got different types, right?
Mhm.
So talk with your CPA
Yes.
to get to know which one, what you should do. But for my realtors out there, one of the best advice that my mentor gave me. Actually, he was on here. Check out that episode, Mr. Clarence Graham. I don't live off my commissions. Okay. I don't live off every check that I make. I pay myself a portion. Matter of fact, it's a fixed amount. Okay. Whether I sell 10 houses a month or I only sell one, I still pay myself the same amount each and every month. I put myself on salary. And I think, for a lot of my agents out there, this will help you out. And when you have those seasons when it's like this, but you're gonna have those times when you're gonna be selling so much, but you need to pay yourself the same amount. You don't want to ball out when when you selling all those houses. Hey, it's gonna be a time where you're gonna need to pace yourself and save for a rainy day. And that's what that fixed amount. That's one of the things that, when I got my real estate license, that might be some good advice for you, Don. When I got my real estate license, I started an LLC and I paid myself. Okay. When I started making money, I started paying myself out of that business account. Okay. So I think for our business owners, there we go, EJ. Like for my business owner, pay yourself a salary, man. Don't live off of what every dime you make, because you never know what tomorrow looks like for an entrepreneur or a business owner. So yeah.
Well, that's well said. Well said. And I'm just going to leave this on this note. Bank statement loans are not, the idea is not, it's just understanding them, right? Like anything, when you understand what you're getting into, like you have a choice. Either you're going to show more money on your taxes and make sure you if you owe money to the IRS, make sure you set that money up on a payment plan. Or you're going to put more money down and have to take a little bit of a higher interest rate if you don't want to do that neither. So it's kind of like your choice. So, Gavin, do you have any parting words before we end this?
Nah, guys. Well, as we wrap up, I know we're gonna take a break next week because, of course, next week is Thanksgiving week.
Yeah.
Spend some time with the families, and we hope you guys do the same. We hope that everyone remembers this, the time of the season, and just remember what you're thankful for throughout the year. We're definitely thankful for everybody who's tuned in.
Absolutely.
As we've been doing Teach Me Tuesdays, we appreciate the love, the shares, the likes. EJ, you don't have to be scared of 10 to 12%. You're a homeowner, and we have solutions for you. You just give us a call. But outside of EJ, guys, definitely stay safe and find what you have to be thankful about, regardless of what your situation and circumstance is. I guarantee you have a lot to be thankful about than you know. So that's all I got to say.
All right. Well, until next time, we will talk with you guys later.
All right, guys.
All right. Peace out.